How do creative real estate investors pay full price for an investment property and make money? Hear that question a lot because most people associate real estate investors with the typical wholesaler who has to get a house under contract for 50% to as much as 70% of fair market value. And if you do a lot of outreach to sellers, you'll hear that a lot of times, especially today. We hear that in the market a lot. Oh, you're an investor. You're going to try to steal my house. And it's really surprising to them when we say, no, Mr. Seller. As a matter of fact, I can pay you full price for your house today. Okay, how does that work? That's the next question that you get. So we can pay full price for a house and still make money. In fact, I'm going to show you an example today of how you can pay full price for a $250,000 house and still make over $50,000 in profit within 36 months. So how do we pay full price for those properties and still make money? That's what we're talking about today on the Sub2Deals Show. Hey, Sub2ers, I'd like to welcome you to this episode of the Sub2Deals Show, where we talk about all things subject to. Now, occasionally we will talk about other real estate investing topics, but it's always something to help you with your real estate investing business. And today's topic is, how do real estate investors, how can we pay full price for a house and still make a profit? And it's something unique to creative real estate investors. We can do that. Now, I know there are a lot of long-time landlords out there that go out and pay full price for houses and rent them out for 30 years and get the house paid off and wait for that delayed gratification when they really start making some money. But I decided early on as a real estate investor, that wasn't the approach that I wanted to take. I'm not a patient person. I want to actually get out there and start making some money today. And about 10 years ago, now I've been investing for over 22 years, but the first 12 were a lot of wholesaling, rehabbing, lease options, seller financing, subject to, buy for cash, buy with investor loans. I did a lot of things. I was a transaction engineer, and being a transaction engineer is great. You can do a lot of things, but I'm telling you, it's a lot of work. And so about 10, 12 years ago, I changed my whole business model and said, how can I do something more efficiently? What was the stuff that I really liked? The things that I really didn't like, I just wanted to remove those from my business model. And I did. And what we really distilled this thing down to was buying subject to, selling with seller financing, buying a particular type of house, really setting up a property avatar. Okay, so we're looking for a very specific property today, a very specific seller and buyer. And it works out so much better. You can say, oh, that's a one-trick pony show, whatever you want to call it. But I want to tell you this. This is a process that is simple enough. It doesn't matter if you have a full-time job or if you work part-time or if you're a stay-at-home mom. Whatever you are, you can do this. Anyone can buy one house a month if they have a process. And we call that the 12 Houses to Freedom. And we talk about it all the time in our Sub2 Max group coaching program or in the Sub2 forum or on our podcast from time to time. We actually did a podcast earlier about the 12 Houses to Freedom and breaking that down. But today we're talking specifically about how we make money on no equity properties. Okay. And there's actually 3 points that allow us to do that. And just very quickly, the first one, of course, is a markup on the price of the property. Now, we pay full price, full market value, and then we sell that house with seller financing for slightly above market value. When I'm talking about slightly above, I'm not talking about 25% or 50% above market value. We really want our buyers to be able to refinance within 36 months. And we want them to be able to have some equity in doing that. And we typically get 8 to 10% down from our buyer, but we also want them to be able to build some equity. So that's the first point that allows us to make money. The second is going to be the interest spread. Typically, most loans that we're taking over are going to fall somewhere between 2.5%, 4.5%. And we're going to sell these properties to our buyers for usually somewhere between 6 and 9%. It really depends on the number that we need to have it at for cash flow, for the cash flow that we're looking for. And we have an absolute floor on cash flow of $300 a month. We shoot for somewhere between $450 and $500 a month is what we're trying to get. So we'll manipulate those numbers a little bit to get the cash flow that we need, and also try to stay just slightly above market rent. That's really where we want to be. It's really a sweet spot. And most people that are renting, if they're renting and they're paying that, then they can certainly afford to pay, an extra $50 or $100 a month to own a home. So that's the second place. And then the third profit center is going to be your back end payday. And what's going to happen is most of the houses that we buy, our sellers have had them for a year, 2 years, 3 years, or longer. So, and if you've looked at any amortization schedule, in the beginning, you pay very little principal, but over time, that principal payment part of the total payment grows. So when we buy a house that we're 3 or 4 or 5 years into that amortization at a lower interest rate, our principal pay down is much greater than our buyer just walking in the door. So that creates growth on the back end. I like to tell people it's like my buyer putting money in a savings account for me each and every month. So every month they make a deposit into a savings account just for me, and we're going to collect on that in the next 2, 3, 5 years. So those are really the profit centers. But let me break this thing down for you just a little bit and show you exactly what we're talking about. So we're going to come over here, share our screen, and show you what we're talking about on this particular house. Now, here's a really good example. You buy a house worth $250,000, and of course, you can still do that in a ton of markets across the country. So we get this house for that's worth $250,000, and maybe we buy that house for $240,000. Now, is there $10,000 in real equity in this house? No, and we know that. The sellers generally know that. Could we pay $250,000? Sure, we could, but most of the time, this is a fairly reasonable thing to expect. Okay, if that seller listed that house with an agent for $250,000, they would be looking to pay that agent $17,000, $18,000 just in commissions to sell that house. So already they'd be coming out of pocket $7,000, $8,000, $9,000 just to sell. Add on any other seller side of the HUD closing costs, they could expect to come out of pocket between $10,000 and $15,000 to sell that house. So if we buy it for $240,000, are we doing them a favor? You bet. Okay, it's not uncommon to find these loans at 3.5%. Happens all the time. So in our example, that's what we're talking about. And maybe they've only owned this house 1 year. Maybe they're in the military. They came out, they bought a house. Now they've got to transfer. They've got to move very quickly. There's little to no equity in that house. And that's the house that we're going to use in our example. Now, our principal and interest payment is $1,077 a month. Now, taxes and insurance are $300 a month. So our total principal, interest, taxes, and insurance is $1,377 a month. Okay. And the average rent rate in that area for $250,000 house, 3-bedroom, 2-bath, is about $1,600 a month. And in most markets, that's a pretty fair rental rate. Now, how do you determine that rental rate? If you have a service like PropStream, you want to use that. Maybe you can use Rent-A-Meter, and that's a free service online. Or you can use Zillow. They quote rental rates. The best way to get what you know is an accurate rent rate is to call some real estate agents or some property management companies in the town that this house is in that you're looking at, and say, listen, I'm looking, I've got a house here on Oak Street, 3-bedroom, 2-bath, very good condition, and I want to possibly use it as a rental. What could I expect to collect easily in this market on that. And they'll give you an idea about what you could expect. So you may look those rent rates up on, like I said, PropStream if you got that service, or Renometer or Zillow, but always verify with a local property management company, because we've seen Zillow and PropStream be off on those rent rates. Okay, so we're going to purchase that house and we're going to sell it for $269. Now remember, this house is worth $250, so we're marking this house up about 7-8%, not a whole bunch. Okay, that's a fair markup, and chances are, if I called 3 appraisers and I've got that house under contract for $269, somebody's going to give me that price. It's not a stretch. Can you adjust it? Sure. Can you sell it for $250? Absolutely, you can, if you've got a problem with marking it up a little bit. But I'm telling you, we've been doing this for over 10 years. That's a very fair number. You're not going to have a problem getting an appraisal 2, 3, 4 years down the road when your buyer refinances. Now, we always get 8 to 10% down from our buyer, and you can expect that. In this case, we're looking at about 8.5%, 9% down, $25,000. People have the money to put down on these houses, and that's less than 10%. These people, most of them, have credit challenges. They can't qualify. They're either self-employed, they don't have provable income, maybe they had a bankruptcy recently, maybe they got a divorce, something happened to their credit, and for that reason, they're buying from us. A lot of conventional lenders these days are looking for 20% down on a house. So we've even had A credit borrowers buy from us because the down payment requirement's not as much. Okay, so all these people don't have to have bad credit, but that's a fair expectation of a down payment on this house. Now, we'll finance the balance, which is $244 at 7% for 40 years. Now, you may be shocked to see 40 years. Listen, there's nothing in Dodd-Frank or any other legislation that prohibits you from amortizing a loan over 30 years. I get that question a lot. You can amortize it over 50 years if you want to, or 60 years if you want to. It doesn't make any difference. We do 40 years because it gives our buyer a slightly lower payment. It really increases the back end on what we get paid. Okay, so that's what we like. That's what we do. You can do it too. It's no problem. Okay, the principal and interest in this scenario for our buyer is $1,516 a month. The taxes and insurance are another $300 a month. So this gives our buyer a total principal, interest, taxes, and insurance payment of $1,816 per month, which is a couple $100 a month more than rent. It's a little bit higher than we normally like, but this is a super nice house in a nice neighborhood, and that's what we needed to do to get the cash flow where we wanted it. This is going to give us a cash flow of $439 per month. Okay, and that's what we're looking for in this case scenario. So in 36 months, and that's generally when we try to target our buyer refinancing us. Okay, we shoot for 24 to 36 months, and 84 to 86% of them, give or take, every year are able to do that. So in 36 months, we're going to owe $226,103 on that house. Our buyer is going to owe us $240,402. Okay, now remember, when we took over the payments on this house, the balance was $240. But see, we've paid down in just 36 months, we've paid down over $14,000 on this house. But our buyer has only paid down $3,600. Remember, we financed $244 for those guys, and that's the power of that amortization and that back end pay down that we were talking about earlier. Okay, this gives you a back end payoff of over $14,000. Now remember, originally we owed $240 and our buyer owed us $244. It's only a $4,000 difference, but our back end payday grew by over $10,000 in just 36 months because of those two factors: interest spread and amortization. Okay. So what are our profit centers on this deal? $25,000 down payment. Now, will there be some closing costs for us? Will there be any fix up or repairs on that property to come out of that $25,000? Maybe. It depends. If you get the house that we're talking about, there won't be any fix up. It's going to be in move-in condition. Will you have some closing costs? Possibly. Okay. So maybe that number is just a tiny bit lower, but not much. The $439 a month by 36 months, that's $15,804 you're going to collect on your cash flow. And the $14,300 back end profit means your total profit on a no equity deal is over $55,000, okay, over 36 months. And that's how you make money on no equity deals. Okay. If you guys have any questions about this, we'd be glad to answer those for you. What I'm going to suggest to you to do is check us out at our $7 coaching. Okay. If you're just getting started, if you're on a budget, I guarantee you this is the lowest cost, highest quality coaching you'll find on the planet. And that's $7coaching.com. Okay. So check us out there. Listen, hope this helps you guys on how to make money with no equity deals. Check out our other podcasts. Go check out the $7 coaching group. We'd love to have you do that and love to have you inside of the group. So until next time, keep talking to some sellers and buying some houses.